Hi, my name is Cajun Zyret. Today we are discussing the long-term investment potential associated with the stock market, focusing on fundamentals such as diversification, risk and reward, and investor behavior. Every investor wants to maximize return, which is the earnings or gains from giving up surplus cash. And every investor wants to minimize risk because it is costly. To invest is to assume risk, and you assume risk expecting to be compensated through return. The more risk assumed, the more the promised return. So, to increase return, you must increase risk. To lessen risk, you must expect less return. But another way to lessen risk is to diversify and to spread out your investments among a number of different asset classes. Investing in different asset classes reduces your exposure to economic, asset class, and market risks. Concentrating investment concentrates risk. Diversifying investment spreads risk by having more than one kind of investment and thus more than one kind of risk. To truly diversify, you need to invest in assets that are not vulnerable to one or more kinds of risk. For example, you may want to diversify between cyclical and counter-cyclical investments, reducing economic risk. Among different sectors of the economy, reducing industry risk. Among different kinds of investment, reducing asset class risk. Among different kinds of firms, reducing company risks. To diversify well, you have to look at your collection of investments as a whole portfolio rather than as a gathering of separate investments. If you choose the investments well, and if they are truly different from each other, the whole can actually be more valuable than the sum of its parts. In traditional portfolio theory, there are three levels or steps to diversifying: capital allocation, asset allocation, and security selection. Capital allocation is diversifying your capital between risky and riskless investments. A riskless asset is the short-term, less than 90 days U.S. Treasury bill. Because it has such a short time to mature, it won't be affected much by interest rate changes, and it's probably impossible for the U.S. government to become insolvent or go bankrupt and have to default on its debt within such a short time. The capital allocation decision is the first diversification decision. It determines the portfolio's overall exposure to risk or the proportion of the portfolio that is invested in risky assets. That, in turn, will determine the portfolio's level of return. The second diversification decision is asset allocation, deciding which asset classes and therefore which risks and which markets to invest in. Asset allocations are specified in terms of the percentage of the portfolio's total value that will be invested in each asset class. To maintain the desired allocation, the percentages are adjusted periodically as asset values change. Asset allocation is based on the expected returns and relative risk of each asset class and how it will contribute to the return and risk of the portfolio as a whole. If the asset classes you choose are truly diverse, then the portfolio's risk can be lower than the sum of the assets' risks. One example of an asset allocation strategy is life cycle investing, changing your asset allocation as you age. When you retire, for example, and forego income from working, you become dependent on income from your investments. As you approach retirement age, therefore, you typically shift your asset allocation to less risky asset classes to protect the value of your investments. Security selection is the third step in diversification, and it is choosing the individual investments within each asset class. Here is the chance to achieve industry or sector and company diversification. For example, if you decided to include corporate stock in your portfolio, which is asset allocation, you decide which corporation stock to invest in. Choosing corporations in different industries or companies of different sizes or ages will diversify your stock holdings. You will have less risk than if you invest in just one corporation stock. Diversification is not defined by the number of investments, but by their different characteristics and performance.